Good morning, everyone. This is Bob Dole again from Solution Driven Wealth. Today is October the 1st, 2020. And this morning, we're going to talk a little bit about the disconnect between both the stock market and the economy. Our main message to you is for the health and well-being of you and your family. Obviously, our entire team here at Solution Driven Wealth cares about your well-being. So really hang in during this period, and please feel free to reach out to us with anything that you might have a question about. So clients ask us, were we in a recession or not? And we certainly were. We had a complete quarantining of not just ourselves, but our entire economy. So certainly economic output was reduced. However, since March 23rd, we've really seen an improvement of the markets and also the economy. Some key measurements that we look at are what we call the ISM Manufacturing Index. And anytime this is above 50, it represents a good output and a good indicator of economic activity. While everyone looks at the ISM PMI, which is a producer manufacturing index, we really want to look at the services. 70% of our economy is driven by services. So to see this index above 50, nearly 57, is a really great sign. Why has the stock market improved so much since March 23rd to present? Well, as we've said in many of our review meetings, stock markets do not move with the economy. They're actually leading indicators. The market, frankly, thought that we were going to be in recession, and it predicted it. And really, we're moved out of that. So we hit a bottom on March 23rd, and since then, the markets have really rallied. We try to take historically, how long do recessions last? And typically, market advancements or bull markets typically advance about 6.5 years on average. That's the average bull market. Recessions last, maybe 3, 6, 8, 9 months at most. And you can see historically, going all the way back to 1957, the recessionary periods that we've had, and then the markets advance after that. So really, you can see where we bottomed and how the economy or how the markets have advanced since that period of time. Are the FANG stocks, Facebook, Apple, Amazon, Google, Netflix, and Microsoft, are they really overvalued at this stage? And what we actually can look at are some ratios that are pretty important. I'm going to get a little technical for a moment. And what we want to go back in time is most people remember Peter Lynch, who managed the Magellan Fund in the 80s to wide acclaim, and he did a great job with that fund. He actually coined the ratio PEG, which means price earnings and the expected growth of the company. And that's earnings per share growth. So when we actually use that, we can measure that against other stocks. It's not just what the price earnings ratio is. That's important. But what is the expected growth rate in the coming months of that specific company? And when we actually do that and use those ratios and compare them next to other companies that we really actually like a Johnson & Johnson, for instance, we can see that Apple's PEG ratio is 2 compared to Johnson & Johnson's, which is 8. The lower the PEG ratio, the better the valuation of the company. So we feel that the technology stocks are actually not as overvalued as we might think. What the coronavirus has done is accelerated some trends that were already in place in the economy, the move away from, say, brick and mortar retailers to more online and e-commerce trading. So we've certainly seen that develop. And we've also seen that some of the companies in these areas, be it web services or consumer discretionary or advertising or streaming services, it's very, very expensive and takes a tremendous amount of capital to have a point of entry to compete with some of these companies. So to compete with in web services, you're competing with two Goliaths, Amazon and Microsoft. In consumer discretionary, where Amazon is a dominant player, it's very, very difficult to compete with them. We talk about Facebook and Google. What are those companies? They're really big advertisers. So to compete with these types of companies, the point of entry is very, very hard. And unlike in past years where advertising was somewhat regional, Facebook and Google's advertising domain is not just regional, it is global in nature. Right now, it's estimated that we receive about 30% of our content from media from streaming services. It's estimated by Capital Group, a large firm that we get research from, that by 2030, 80% of the media that we receive will be via streaming. That's an incredible statistic and represents a big change in how we receive our data. So what should I do with this information? Well, again, just because some tech stocks are doing very well, it doesn't mean that you should all jump into tech stocks. But again, we want to bring it back to what your specific situation is and what are your goals and objectives. You have a specific plan and strategy. It should not be disrupted by what we call noise that you receive from the media. Unfortunately, today, there's a very small amount of news in the marketplace and a lot of noise. And we don't want that to do is take you off your game in terms of your plan and your strategies. The most important thing is that you know that we really care about you, your plan, your friends, your family, and that you've been so nice enough to refer us to. We're constantly looking at ways to enhance your situation, improve it, make it better. And if you ever have any questions about your situation specifically, obviously we're reaching out to you on a continual basis. But if anything comes up in the interim periods, please reach out and talk to us. Give us a call. We're always able to speak with you.